Your coins are just sitting there and earning you nothing. Meanwhile, others use their coins to earn additional interest. How? They lend their coins. That's called crypto lending. Sounds simple, but many underestimate what's really happening behind the scenes. So let's take a look at how lending works, who pays the interest, and what risks you need to understand. You actually already know the principle from banks. You deposit money at a bank. The bank lends that money to others. The borrower pays interest, and you receive a portion of it. Crypto lending works in a similar way. But instead of euros in a bank account, we're talking about cryptocurrencies. Simply put, you provide your coins. Someone else can borrow them, and you earn interest in return. In practice, this often happens with stablecoins. For example, USDC or USDT. Why? Because stablecoins fluctuate much less in price than Bitcoin or Ethereum. That makes returns more predictable. But Bitcoin and Ethereum can also be lent out, depending on the platform. However, the risk is higher. You may earn interest, but the price of those coins can drop significantly. That means you can earn interest and still lose money overall if the coin decreases in value. Also important, you can't lend every coin. Lending only works with coins that a platform or protocol supports. Now, there are two types of lending. First, centralized platforms. Here, you give your coins to a company. The company manages them, lends them out, and pays you interest. It's simple for you, but you have to trust the platform because your coins are no longer directly under your control. Second, decentralized platforms. Here, there is no traditional company involved. Everything runs through smart contracts on the blockchain. You connect your wallet, deposit your coins into a pool, and other users can borrow from that pool. Now the key question, who actually pays the interest? The answer, the borrowers, the people who take out the loans. On centralized platforms, this is handled by the platform. They organize everything and usually keep a portion of the interest. On decentralized platforms, borrowers pay interest directly into the pool. From that pool, lenders are paid. So the interest doesn't come out of thin air. If few people want to borrow a coin, interest rates are usually low. If many people want to borrow it, interest rates can rise. How much you earn depends on the coin, the platform, demand, and risk. Often it's a few percent per year, sometimes more. But higher returns almost always mean higher risk. Now the question, why would anyone borrow coins? There are several reasons. The most important ones are trading and liquidity. Let's look at trading. Traders borrow coins to trade with more capital than they actually own. This is called leverage. A simple example. A trader has 1,000 USDT. Normally, they can buy $1,000 worth of Bitcoin. If they borrow another 1,000, they can trade with $2,000. That's 2 times leverage. If they borrow 4,000 and trade with 5,000 total, that's 5 times leverage. If the trade goes well, they make more profit. And that's exactly where the interest for lenders comes from. But if it goes badly, they lose money faster. On top of that, they pay interest on the borrowed coins and often additional fees. Another important reason people borrow coins is liquidity. Imagine someone owns Bitcoin and doesn't want to sell it. Maybe they believe the price will rise long term, but at the same time, they need money for rent or bills. Instead of selling their Bitcoin, they can use it as collateral. They deposit it and borrow stablecoins in return. They can sell those stablecoins and convert them into cash. This way, they get access to money without selling their Bitcoin. That sounds reasonable, but here's the risk. An example, their position is worth $10,000. They borrow around $5,000 in stablecoins. Why? Because the platform requires a safety buffer. If the Bitcoin price drops, the collateral loses value. If the buffer becomes too small, the position is automatically liquidated. That means part of the Bitcoin is sold to repay the loan. The problem? They wanted to keep their Bitcoin. Instead, it gets sold while the price is falling. That means they lose part of their Bitcoin without wanting to. That's the risk. Still, many people do this because they get access to money without selling their Bitcoin. And that's exactly what they pay interest for. That interest goes to the users who lend their coins. Now let's talk about the risks for you as a lender. Because lending is not just earning interest without risk. The risks are, first, price risk. If you lend Bitcoin or Ethereum and the price drops significantly, your losses can outweigh your interest. Second, platform risk. On centralized platforms, you give up control of your coins. If the platform gets hacked, has financial problems, or goes bankrupt, you could lose your funds. Third, smart contract risk. On decentralized platforms, you trust the code. If there are bugs or security vulnerabilities, you can lose money. Fourth, liquidity risk. You can't always access your coins immediately. With fixed terms, you have to wait. And on decentralized platforms, there needs to be enough liquidity in the pool. So, what does this mean? Lending can be interesting, but it's not risk-free. You earn interest, but you take on risk in return. Quickly, the difference to staking. With staking, you lock up coins to help secure a network and earn rewards. With lending, you provide coins so others can borrow them and you earn interest. Who is lending a good fit for? Mainly long-term investors who plan to hold their coins anyway and want to generate additional returns. Many use stablecoins for this because the risk is more predictable, but even stablecoins are not completely risk-free. If you enjoyed this video and want more simple crypto explanations, feel free to leave a like and subscribe to the channel. If you have questions or want to see a specific topic, write it in the comments. Thanks for watching and see you in the next video.